Welcome to Market Movers. I'm Jim Urio, and today we're talking about our ever-shifting political climate and the potential for any real policy moves in the next few weeks. We're going to be looking at using S&P weekly options as a way to hedge risk or increase exposure to these potential events. Since we're talking about equity indices today, I want to quickly mention that the Russell 2000 index is coming back to the CME on July 10th, and we're going to be watching that closely. So let's get to it. Joining me is Chief Investment Officer of Kingsway Asset Management, Scott Martin.
Hi, Jim.
Okay, the Georgia election results. Were they a big deal? Did they really take the political temperature of our country?
Maybe a little bit in the sense that you've seen the problems that the president's had getting things through Congress thus far. So does this change that outlook? Probably not, because this Congress, which was expected to be so favorable for this president, has really stood in the way so far.
I thought it was a big deal, but the markets don't seem to agree with me. I thought that there'd be a lot of politicians who are opposing or not siding with Donald Trump now who might, but we haven't seen it so far.
No.
Paul Ryan gave a speech on taxes. Was that a big deal?
Well, I think the market is starting to figure out that this rhetoric may not be able to be counted on. And I believe that that's what's slowly seeing some of the bleed out of this market with respect to some of the buying interest, with respect to how much really is going to go through by, say, the recess in August or even the end of the year.
One more question. If they had some really hard rhetoric on tax reform or regulatory reform, is that enough to push the stock market to new highs?
I believe it can push the stock market to new highs for a temporary period, but at some point you have to see the devil show up in the details, which we haven't seen yet.
Okay, now before we dive into our trade discussion, I'd like to point out that as with all market movers, it's important to view these trades as examples that allow you to see different ways to use futures and options products to either manage risk or create additional trade opportunities, not as recommendations or advice. Prices and movements are going to vary on these. We're looking at this, the market's trading about 24.35 in the SEP S&Ps.
Correct, and we're heading into that pretty lull of a season trading-wise with respect to the end of Q2 and the middle of summer or the start of summer, but it already feels like kind of midsummer because the weather's been so nice. So I punched up a few things today and just looked at the markets, and you mentioned we're trading around 24.35, Jim, and I thought, okay, what are some decent ranges to put into the charts here that might represent an area where the market could move around, but not really move too much, because that's what I think we're going to see here in the next, say, week and a half. So specifically, I looked today at what's called an iron fly. So if you can make your fly shapes, that would be great, because I'm actually selling the 24.35 straddle for about 23 ticks. So you take in that premium, but you don't just sit there naked. You buy some protection via wings on the fly, buy a 24.50 call and buying a 24.20 put. That's going to cost a total of 13. So you're going to bring in a net premium of 500 with a max loss of 250 if the market tends to widen out towards those wings. But you have that range of the 24.50, 24.20 to operate within, which are the highs and lows from the last 6 months or so.
I like it. So basically what you're
saying
saying is nothing's going to happen.
Not by the end of next week, because this expires on the 30th, which is just after my birthday on June 28th, so please hold the cards. But the reality is, this could be a period in which the market does nothing and you can capitalize on it.
I like a trade like that, but I like volatility as well, so I'm hoping it doesn't work. I'm looking at it a little differently, and I think there might be some rhetoric that makes the market think that things are going to be better. So I'm looking at buying the end of the month 24.50, 24.60 call spread for 3 ticks. This goes off on the 30th, and it has the September underlying, which is currently at 24.35, so it's 15 ticks above the market. This trade risks 150 put out to make 350. Again, it's a low risk to make about 2.5 to 1.
But similar to my exposure there, you have that same level on there at 24.50, which I believe if you're long, if you're looking to maybe get some protection on, that's a key level to put in with respect to some of your trade reconciliations, because that's the recent high from the S&P, give or take a couple points.
I like it. Thanks for joining us in this special edition of Market Movers. I'm Jim Urio, where we're hoping to make you a better trader.